Good morning, and thank you for joining us this morning. This is Mark Bowd of Real Estate Economics, and we appreciate you joining us for our weekly webinar series. This morning's webinar deals with the Inland Empire of California, both Riverside and San Bernardino counties. What we'll do is we'll review the housing market as well as the economy. We'll give 5-year forecasts and show you how we think the housing market reacts to our 5-year economic forecasts. Before we do that, I just want to review what our schedule is going to be for the next couple of weeks. Next week, on June 9th, my associate John Mulville will present a webinar on San Diego County and its economy and housing market. The week following, or the week after that, we'll present a webinar on the East Bay of Northern California, which will be a presentation of both Contra Costa and Alameda counties. Just a reminder, we are on Twitter, we're on YouTube. We present these each week and post them on YouTube so that you can see them at your convenience. So going into the current housing market conditions, what I'm first going to do is go to our website and go directly to the products that we offer, Housing Transactions Report, to give you a good idea as to what's going on in both Riverside and San Bernardino counties. You can see what I'm doing here in terms of following our menu. I'll select all areas of both of these counties, select all zip codes, and what we'll do is I'm going to actually pull just the most recent month's worth of data, which is April of 2010. I'm going to pull all kinds of information, both traditional resales, new home builder closings, foreclosures, which is a property that is going back to the lender, and then foreclosure sales, which is our measure of when a property leaves that lender and gets sold to a new entity, typically a new owner. There are ways to filter our data by price range, by unit size, by bedroom and bathroom count. We'll leave these alone for now just to give you an overall picture as to how these markets are doing. And the first thing you'll see is a color-coded map which shows you what's going on in this market in terms of transactions. Each of the blue dots represents a resale. Each of the new home builder closings are represented by a green dot. Foreclosures are shown in red, and foreclosure sales are shown in orange. And you can see from the overall pie chart to the side that this market is still being dominated by distressed housing transactions. Both foreclosures and foreclosure sales still add up to more than half the market. There's only a small sliver of the new home market, and then a larger sliver, but much smaller than traditionally for resales. We're going to actually run a report that shows the transactions for this particular market. While we'll do that, I'm going to pull up Excel and actually show you what that report looks like. Here it is. And the reason we produce these reports and have them loaded directly into Excel or Microsoft Word or other programs is so that you can use it. We want you to use this information. We want it to be interactive, and we want you to be able to use it as a tool in your planning purposes. And so for that reason, we want it to be you be able to see our formulas, our templates, and everything else. So during the past month, of which data is available, the month of April, there have been 11,588 transactions. Now that's 7% higher than what it was a year ago, which was 14.4% higher than what it was 2 years ago. And so we've had 24 months straight of increasing sales volume. That's a very good sign. You can see that graphically here, where both condominiums and single-family homes have increased in terms of sales volume. Part of the reason it has increased, obviously, is because we have extreme values in this market. During the past 24 months, prices have fallen from an average of $304,525 down to $222,000. Now that's actually quite a bit higher than what it was 12 months ago, and so we've obviously formed a floor in this market in terms of price. In fact, prices have increased an average of 12.5% during the past 12 months. Now, I need to couch that by saying that that's not all appreciation. Indeed, so far, very little of it has been appreciation. It's more a reflection of a reduced level of foreclosure sales and somewhat of foreclosures, though foreclosures are still a very large piece of the pie. as well as reflecting where those sales are occurring. We're getting fewer sales in some of those outlying areas that are less expensive and more sales in some of the core areas, including more foreclosure sales as an increasing number of buyers take advantage of distressed housing in more potent areas of the Inland Empire. So overall, there's been 4,600 traditional resales. That's quite a bit higher than what it was a year ago and 2 years ago. So a lot of the rebound has occurred in traditional resales, which is a good sign. New home builder closings, however, have remained flat. We're still at about 370 new home builder closings, about the same as what we had a year ago, far lower than where we were 2 years ago, as builders are still finding it hard to find construction financing and actually build the homes. We think that if they could build them and offer them at the rates that they're offering, they would sell them. Those few that are offering new homes are actually experiencing very strong absorption right now in a lot of areas of the Inland Empire. Foreclosures have actually gone up quite a bit. They've gone up from 2424 foreclosures 12 months ago to 3378. This was not entirely unanticipated, as the banks have observed more healthy market conditions or stable market conditions, and because of that they're actually releasing more of their distressed inventory. And because of that, we're also seeing a lot of foreclosure sales. Those are actually down from a year ago. I think that is partly a function of just the transition, where we've had just a recent big bump in foreclosures, and this foreclosure sale number should go up as those prices are released, especially these distressed prices, where that distressed inventory, when it is released and exposed to the market, we think will absorb relatively quickly. It just hasn't been exposed long enough. This increase in foreclosures hasn't been exposed long enough to readily absorb yet. Just to show you what's going on in terms of some of the other charts, overall mortgage amounts, they're down to 88% loan to value. That's historically low for the Inland Empire and reflects those tightened lending practices that I talked about. And here are the patterns of sales volume by housing transaction type, where you see big increases in resale volume, especially during the past 12 months, a very healthy sign. A reduction from 24 months ago to 12 months ago in foreclosures, but it's gone up again as banks have increasingly felt they could release that distressed inventory. Here are foreclosure sales. Now, foreclosure sales are down. We think that's temporary. We also think that at least they're still somewhat matching foreclosures, and we think that they'll actually exceed foreclosures as the banks continue to release them and expose them to the market. So that's what the overall housing market has done during the past month, for which data is available. We think that there are indicators that the market is improving. There are other indicators that certainly show that it is still in distress, especially with the amount of foreclosures that it is having. It's going to improve. It's going to continue to improve. The prices will continue to stabilize, but will be improving in fits and starts with the things that we're doing and throwing into the system to kind of cause temporary fixes, such as the housing tax credits and other things which more distribute or dislocate demand relocate demand as opposed to allow that current stream of improvements to occur. We think that that continues through year 2010, and during year 2011 we think we'll be on more stable ground. We'll see more appreciation, mainly as the economy begins to kick in. We think that we'll experience that positive job growth on a 12-month basis beginning around fourth quarter of this year. We've already seen improvements, and we're heading toward positive territory, but it hasn't quite kicked in the Inland Empire the way it has in some of the other markets of the nation. That ends this 10-minute segment. Continue with me for the next 10-minute segment, and I'll show you what's going on in terms of the economy, what our forecasts are in terms of housing supply and economic improvements.